CPP Investments, the Crown Corporation that manages the investment fund for the Canada Pension Plan, recently published their annual report for fiscal year 2025, and the results are not great. I generally don't like to use sensational language, but I think this might be some of the most egregiously self-serving behavior I've seen from a public institution, and that's saying something. I wasn't actually planning on making another video about CPP Investments, but there's some fairly concerning stuff in this report related to their new performance benchmark and the bonuses they're paying themselves, so I wanted to break down what's changed since last year and how they're doing now. If you haven't seen it, I published a long video a couple of months ago about CPP Investments, going over their history and their performance since the fund was established in the late 90s. I'll give a super quick recap here, but if you want more context and details, I'd suggest watching that original video first if you have the time, because it covers quite a bit more than what I'm going to go over in this one. So to refresh your memory, since 2006, CPP Investments has been pursuing an active management strategy, meaning that rather than trying to passively match the returns of the overall market, they've hired a lot of fund managers and support staff to select individual investments and strategies. This type of management is a lot more expensive and complicated. They have over 2,000 employees spread across offices around the world. In the 2024 fiscal year, for example, we spent over $1 billion on personnel, hundreds of millions on administrative and overhead costs, and about $3.5 billion on external managers. In order to justify all of these costs, when they started this active management strategy, they created something called the reference portfolio, which was a passively managed mix of stocks and bonds designed to meet the long-term payment obligations of the Canada Pension Plan without taking on an excessive amount of risk. In their own words, this represented an investable strategic alternative to the active management scheme and was therefore a fair basis to evaluate their performance. This was both their performance target and their risk target. The reasoning was that using active management, they would be able to achieve higher returns for the fund at the same level of market risk as the reference portfolio. However, in last year's annual report from 2024, they massively underperformed that benchmark, returning only 8% against a benchmark return of 19.9%. In dollar terms, this represented roughly $64.1 billion in missed returns for the fund, wiping out significantly more value than their active management strategy had added over the past 18 years combined. This is a pretty common way for active management to underperform over the long term. They may beat their benchmark by a little bit in many years, but there will be a few years where they underperform so badly that their overall long-term performance is below the passively managed alternative. However, rather than re-evaluating their active management strategy and considering whether or not we should return to a low-cost passive management scheme, they decided instead to just change their performance benchmark. Apparently, the reason they were underperforming the reference portfolio was just that it was a bad benchmark, and we needed something that more closely reflected the strategy they decided to pursue instead. That benchmark change took effect for this year's report. That brings us to the latest annual report, fiscal year 2025. This year, the fund returned 9.3%, but you'll notice that they left the relative performance compared to the benchmark off the summary page. In previous years, this is what they've done whenever they underperform their benchmark, and this year is no exception. Their new benchmark returned 10.9%, meaning that they underperformed by 1.6%, representing about $10.8 billion in missed returns. The old reference portfolio, which has been rebranded as the market risk target, returned 13.4%. Compared to this benchmark, they underperformed by 4.1%, or about $27.6 billion. On the good news side, they didn't increase staffing levels this year, maintaining the same number of employees at 2,125, which they say represents an increase in productivity because the size of the fund increased, but the size of the workforce didn't. Unfortunately, looking at the overall costs, we still saw significant increases in personnel costs, external management costs, and financing costs. The total expense ratio of the fund, excluding taxes and transaction fees, rose from last year's total of 194.5 basis points, or 1.945%, to 197 basis points, or 1.97%. That means that we're continuing to see a diseconomy of scale at CPP Investments. As the fund grows, each dollar under management costs more to manage, not less. Personnel costs also rose, with the average this year rising to roughly $550,000 per employee. While they claim to have increased their staff's productivity, on an overall cost basis, they're getting less efficient as the fund grows. So let's talk about this new benchmark portfolio that they're comparing their performance against. When CPP Investments CEO John Graham was describing the new benchmark in an interview last year, he said it would be an aggregate of internal benchmarks for each portfolio segment that would reflect the type of portfolio that they actually want to build. At the time, there weren't really enough details to know exactly what the new benchmark was, but many people, including myself, suspected that it would be a lower performance target. I said back in July of last year that it sounded like, because their reference portfolio was showing that their overall approach was providing lower returns for the fund, they were just going to build in an assumption that their overall portfolio structure was correct and use that as the new benchmark. I suggested that the way they would do this would be through absorbing something called Diversification and Leverage into the new benchmark. To give a little background here, CPP Investments frequently boasts about how well their portfolio does compared to other pension funds around the world. However, this is mainly because, contrary to popular beliefs about pension funds always being low risk, CPP Investments takes on a relatively high level of market risk compared to many other funds around the world. For the base CPP fund, this is equivalent to a passive portfolio of 85% stocks and 15% bonds, which is higher than the risk tolerance of most individual investors. For reference, an 80-20 split of stocks and bonds is usually considered aggressive, and the 85-15 target of CPP Investments is even more aggressive than that. So coming back to this new benchmark, diversification and leverage is a major part of their active management strategy and involves diversifying the portfolio by investing in more asset types like private equity, private real estate, and so on. The theory here is that diversifying into more of these private asset classes will provide similar or better long-term returns, but at a lower risk than what individual investors can get on their own. Then they add more risk back into the portfolio through leveraged investing to bring the total market risk back to the same level as the reference portfolio, which should, presumably, generate higher returns at their targeted risk level. The thing is, the problem they were having with diversification and leverage is that although it was a major part of their strategy and part of the reason that they need such a large active management team, lately it's been generating negative relative returns. For the 5 years ending in 2024, the value added from diversification and leverage was, on average, negative 4% per year, meaning that over 5 years it lowered the portfolio performance by $97.7 billion. Their other active management component, investment selection and tactical positioning, had added positive 2%, making the net impact of their overall strategy negative 2% per year. Basically, their overall strategy was underperforming, but within that underperforming strategy, they were making some good tactical decisions. But if they were to build in an assumption that their portfolio structure was correct and absorb diversification and leverage into the benchmark, their value add would flip from negative 2% to positive 2% because the performance target would drop by 4%. As we can see from the 2025 report, my prediction about the new benchmark seems to be exactly what they did. Suddenly, their relative performance for the 5 years ending in 2024 went from negative 2% to positive 2%. Likewise, if you look at their sources of incremental return for 2024 versus their sources of incremental return for 2025, diversification and leverage has disappeared, and now we just have the benchmark and investment selection, just like I said almost a year ago. The problem they're having now is that investment selection has also been a negative value add over the last 5 years ending in 2025 at negative 0.7%, and the new benchmark portfolio is still underperforming the old reference portfolio. So now they're essentially making incorrect tactical decisions within an already underperforming overall strategy. As I said before, historically, their relatively high rate of return compared to other pension funds seems to be mostly associated with a higher level of market risk. They used to break this out into a separate category where they'd show the impact of taking a higher level of risk separately from their diversification and leverage strategy, but this year they've combined those into a single category called targeted level of market risk and exposures. The "and exposures" part is what used to be called diversification and leverage. In fact, we can see that they use exactly the same language in the exposures section as they used to use in the diversification and leverage section in previous years. However, by combining them, it has the effect of obscuring the underperformance of their diversification and leverage strategy and papering over it with the higher level of market risk. Fortunately, since we know that the difference between the market risk target performance and the benchmark performance is the same as the impact of diversification and leverage, we can use information from the past 5 years of reports to calculate the latest 5-year impact of diversification and leverage. It comes out to roughly negative 3.5% per year, which make the impact of higher market risk positive 5.3%. By combining those two into a single number, positive 1.8%, it makes it a lot less obvious that their active portfolio strategy is contributing negative value. Just a quick note here, we're talking about all of this in percentage values, but they used to also report a dollar value added, where they would say what the difference in performance was in terms of total dollars. As late as 2023, they were proudly putting this number on the summary page of their reports, even compounding it based on previous returns to show how they'd added tens of billions of dollars in value. However, this year, now that they're underperforming by tens of billions of dollars since the inception of their active management strategy, they've decided to just stop reporting the dollar value and only report percentages instead. It's hard to say exactly what the motivation for that decision is, but it seems very convenient for them to make this change right now, given that we underperformed by 1.6% sounds a lot less significant than we underperformed by $10 billion. I think it's also worth looking at this new benchmark compared to the old reference portfolio because CPP Investments doesn't directly compare the two benchmarks in their report. They're still using the old reference portfolio as their risk target, and the new benchmark is targeting the same level of risk through the use of diversification and leverage, but it's getting worse returns. They say they've made the switch because they no longer consider the original reference portfolio a prudent and investable alternative, but based on the information in the report, the new benchmark seems to just be objectively worse. If you plot them side by side, you can see that the new benchmark not only gets lower returns in good years, but it also suffers bigger losses in bad years. In 2020, the original reference portfolio was down by 3.1%, while the new benchmark was down by 8.1%. In 2023, when the reference portfolio was up by 0.1%, the new benchmark was down 2.5%. The only year they've labeled where the new benchmark even slightly outperformed the old one was in 2021, when it was up by 31.6% compared to 30.4% for the reference portfolio. Still, according to CPP Investments, the blue line is a prudent investable strategy, while the red line is somehow no longer useful or relevant except as a risk target. Personally, I don't see it. I also want to point out another little detail here. In this year's report, when they're comparing the new benchmark to the actual fund performance, for some reason they've left the data labels off for 2024. This is interesting because 2024 was the year that their massive underperformance against the reference portfolio wiped out far more value than their strategy had created over the previous 17 years combined. You can see that the new benchmark performance for 2024 is at roughly the same level as 2025 when the benchmark return was 10.9%, but the data label is missing. It's not in the text of the report either, but using the 5-year relative return along with data from this year and last year's report, we can calculate that the benchmark return for 2024 was roughly 11.1%. This is a massive downgrade from their old performance target of 19.9%, and it represents a reduction in their performance target of more than $50 billion for that year. Personally, I'm skeptical that it's just a coincidence that the 1 year where they had the largest reduction in their performance target is the same one that they failed to label on the chart. This retroactive change to the benchmark mostly eliminates their massive underperformance in 2024, which would have been a drag on their bonuses for years. If you drop this into a table, you can see that the new benchmark performance is worse than their old benchmark for almost every year that they provided a value for. Over the past 5 years combined, this represents a compounded reduction in their performance target of more than $120 billion, and somehow they're still underperforming the new benchmark. But maybe you're saying, okay, so what? They changed the benchmark this year, why does it matter if it's a lower target in previous years? Well, the answer is that their incentive compensation, or bonuses, are based on the past 5 years of performance for the fund. And for this year, instead of applying this new lower performance target going forward when calculating their bonuses, they've instead decided to apply it retroactively, so they're comparing the entire past 5 years to the new target that they brought in this year. So, let's talk about bonuses. The way CPP Investments calculates bonuses for overall fund performance is through a performance multiplier with different components awarded a score between 0 and 2. Then they take a weighted average of the components to calculate the total bonus multiplier. Much like in previous years, they look at the absolute fund performance and the fund performance relative to the benchmark. Getting a bonus for absolute performance is pretty simple. As long as the fund doesn't lose money over the previous 5 years combined, they get a bonus. Stock markets have been up pretty consistently over the past 5 years, so they got a hefty multiplier of 1.44. For relative performance, they got a multiplier of 0.17 because although their relative performance was negative, the bonus curve for relative performance starts well below zero value added. Personally, I find this totally incomprehensible. Outside of this specific situation, I've never heard of a company giving performance bonuses for doing work that actively worsens the performance of the company, but that's how they've decided to do it here. Now, in previous years, those two numbers would be averaged for a total fund multiplier of 0.76, but this year I noticed that their multiplier was significantly higher at 1.04. This is because they've added a new component for this year called Annual Strategic Objectives Performance. According to the compensation section, this is a subjective performance metric that's awarded at the discretion of the compensation board based on how well the fund did on achieving strategic objectives set out at the start of the year. Personally, I'm not sure this needs to be a separate category because presumably those strategic objectives would ultimately be in the pursuit of better fund performance, so it would ultimately show up in the performance metrics anyway. But they did add it in, so can you guess how they scored themselves on this brand new metric on a scale between 0 and 2? That's right, they gave themselves a perfect score of 2.00. Apparently, despite the fund's lackluster returns even compared to their new lower benchmark, they actually did everything flawlessly, made all the right moves, and earned the highest score possible. This seems pretty egregious to me, and again, you can't know for sure what the motivation behind each of these changes was, but the effect of every single one of them was to make the performance look better and generate larger bonuses. If we look specifically at CEO John Graham, he's now been leading the fund for 5 years, which is a full bonus cycle. Over the past 5 years, the compounded fund performance relative to the new benchmark has been about negative $22 billion. If you use the old reference portfolio for the first 4 years and only apply the new benchmark this year, it would be negative $137 billion. If you use the original reference portfolio as the target for the full 5 years, it would be negative $146 billion. For this performance, Mr. Graham was awarded a performance bonus of $5.6 million this year, the largest in fund history. This represents an 805% bonus on top of his base salary of $695,000. Again, we can only speculate on the motivations behind this, but I find it difficult to understand why underperforming every performance benchmark they have deserves a record high performance bonus. Before we wrap up here, I want to talk about the lack of a meaningful response that CPP Investments has given to any of these criticisms. So, one other person in Canada who's been talking about this issue is a veteran journalist named Andrew Coyne. 10 years ago, he said that their active management strategy would probably underperform passive management over the long term. Last year, he wrote another piece about how he turned out to be right, and this year he wrote another opinion column on how CPP Investments was continuing to underperform their own benchmark that they created for themselves, and suggested that we needed some sort of oversight and reform instead of constantly increasing salaries and bonuses for persistent underperformance. CPP Investments actually did put out a response to this one, although instead of publishing it publicly on their website, they sent it out to a group of stakeholders. The only reason we know about this response is that it was posted by Leo Kolovakis on his Pension Pulse blog, where he provides frequent updates on the pension industry in Canada. They sent out a 5-page response to the article titled "Everyone is entitled to their own opinion, but not their own facts." They start off with one of their most common talking points, which is that over the past 10 years, they had the second highest returns among the world's 25 largest pension funds, but, as usual, ignored any discussion of market risk taken in achieving those returns. This is kind of ironic, because one of the following sections is titled "Ignoring Risk is Reckless and Undermines Pension Resilience." It's also worth noting that the fund that outperformed them, Sweden's AP7 fund, is mostly passively managed and has very low management expenses, only 0.07% overall. So using this as an example of how their active high-cost strategy is better than a passive low-cost strategy doesn't really hold much water. When discussing why passive management would be too risky for the fund, they don't compare against the reference or benchmark portfolios that they created to measure their own performance against. Instead, they bring in a completely irrelevant comparison, the S&P 500, to show how much the US equity index fell in major downturns. Most of these downturns happened before the start of active management at CPP Investments, with the exception of the global financial crisis and the 2020 crash, where the US equity markets fell roughly 50% and 25% respectively. The thing is, the reference portfolio isn't just the S&P 500 index, it's a mix of global equities and bonds that they created as a passive alternative that would meet the requirements of CPP. Accordingly, if we look at the reference portfolio performance in those years, we see much smaller declines. In the global financial crisis, the reference portfolio fell by 18.63%, while the actual CPP Investments portfolio fell by 18.62%, so they didn't really do anything to protect us from that downturn. However, in the recovery the following year, they underperformed the reference portfolio by 5.87%, missing out on a significant amount of value. In the 2020 crash, the reference portfolio fell by 3.1%, while the actual portfolio grew by 3.1%, so they did protect from a small downturn in portfolio value. However, the following year, they underperformed by 10%, wiping out significantly more than any benefit that they might have provided in the previous year. It's also worth noting that while the old reference portfolio fell by 3.1% that year, the new benchmark portfolio fell by 8.1%. If their concern is that downturns in portfolio value create a risk that they won't be able to pay out pension benefits, I don't think it makes much sense to switch to a performance benchmark that sees larger and more frequent downturns in value than their old benchmark. They also add that it's important to challenge the idea that nobody beats the market because, in their opinion, institutional investors with more assets and a long-term investment horizon can outperform the market. The problem is, in their own report, they admit that over the past 19 years combined, they've added an average of negative 0.2% per year against their own benchmark that they created to justify this active management strategy. So, if anything, they themselves are living proof that nobody beats the market. They finish up by encouraging people to consider substance over sound bites, but again, they spent 5 pages on this response to Andrew Coyne's article, but they never addressed the substance of his criticism, which is that they're underperforming their own benchmarks, and we should review this active management strategy to see if it's actually providing any value to the fund beneficiaries, or if it's just providing high-paying jobs to fund managers. So to wrap up this video, this is an incredibly frustrating situation for me because all this information is in their own reports, and at this point, it's very hard to believe that all of this is some kind of well-meaning coincidence, given that every single change or omission they've made has the effect of obscuring their underperformance or increasing their bonuses. They set out on this active management strategy almost 20 years ago, and they put a very clear performance benchmark in place to justify it. Then, when it became obvious that their strategy wasn't providing higher returns like they said it would, instead of questioning whether or not active management was the right move, they just created a new, lower performance benchmark, which built in an assumption that their strategy was correct. Then, when they underperformed that new benchmark anyway, no problem, they just stopped reporting numbers that help the public understand exactly how bad their performance is, and everyone gets bonuses anyway. In fact, they went so far as to build in a new subjective component to their bonus calculation and awarded themselves a perfect score. The CEO, who has presided over what is objectively the worst 5-year relative performance compared to their reference portfolio in the history of the fund, is also awarded the largest performance bonus in the history of the fund. Personally, I think this should be considered one of the biggest, if not the biggest scandal in the country. In the past 5 years alone, we've allowed well over $100 billion to slip through our fingers, all because these fund managers think that they know better than everyone else. Even though, by their own measurements, they're providing negative value to the people who pay into CPP, they feel that they're still entitled to their salaries and bonuses because, why not? They're important finance people. It doesn't matter that ordinary people are struggling to afford things like rent and groceries, they feel that they deserve to pay themselves huge sums of money out of our pension fund, from that CPP money that comes off of your paycheck before you even get a chance to see it, for the service of providing negative value for the fund beneficiaries. Practically speaking, there seems to be no real scrutiny, no oversight, and no serious review of this active management strategy. This isn't going to be brought up in Parliament, it's not even going to be on the news. They'll just continue to tell us that they're one of the best managed funds in the world, and most people in Canada will continue to believe it, despite overwhelming evidence to the contrary in their own reports. And look, I'm not saying you need to take everything I've said at face value. Go take a look at the sources, listen to what other people have said, and form your own opinion. At the same time, you shouldn't automatically buy into the fund management industry's commentary on it just because they're the self-declared experts. Obviously, fund managers are generally going to support a system that gives billions upon billions of dollars to fund managers, whether or not they've done anything to objectively earn it. As we saw from the response that was published on Pension Pulse, the communications department will always try to send the message that they're taking the right approach and that they're one of the best managed funds in the world, whether or not they can actually address the substance of the criticism. Like I said in my previous video, I honestly don't know what we can do about this right now other than to get more people talking about it and actually understanding what the concern is. This is a pretty small channel, the videos don't get a ton of views, so unless more people in traditional and social media pick up on this, it's pretty unlikely we'll see any action on it. So if you want anything to actually be done about this, talk to other people about it, and share your concerns with people who can actually help to try to make this a bigger issue. Anyway, that's all for this video, so as always, thanks for watching, and I'll see you next time.